Hello everyone, welcome to this introduction to insurance lesson. If you have ever wondered what insurance is, why people buy insurance, or how insurance companies work, this video is for you. Yes, in this video, we'll cover the basic concepts of insurance, including risk transfer, pooling, insured and insurer, loss exposure, and what are the benefits of insurance. So, by the end of this lesson, you will have a solid understanding of the fundamentals of insurance, even if you are completely new to the topic. So, let's get started. Why do we have insurance? So, there is a saying, life is full of surprises, but not all surprises are pleasant. In our daily lives, we plan for many things. We plan our education, career, savings, etc. etc. But no matter how carefully we plan, some events are beyond our control. So the simple answer is that insurance helps protect us from large financial losses caused by unexpected events. Let's take an example so that this will be clear. Suppose you buy a house. Your house may be perfectly fine today, but tomorrow something unexpected could happen. There could be a fire, a storm could damage the roof, a flood could cause damage. Nobody expects these events to happen, but they are possible. So, if something like this happens, repairing or rebuilding the house can cost thousands or even hundreds of thousands of dollars. So, most people cannot afford to pay such a large amount suddenly. This is where insurance came into picture and helps. Instead of paying a huge amount after a loss occurs, we pay a smaller amount regularly to an insurance company. This payment is called a premium. The insurance company agrees to take on the financial risk. If a covered loss happens, the insurance company helps pay according to the policy. So, this gives people peace of mind because they know they have a financial protection. So, insurance is a risk management technique that transfers the financial consequences of loss exposures to an insurer. Now, you may ask, how does insurance actually work? There are three main important ideas behind insurance. The first is risk, uncertainty about outcomes. The second is transfer, shifting the financial burden. The third is pooling, share costs across many insured. We'll learn each of these concepts in the next slides. Understanding these three concepts will help you understand how the entire insurance industry works. Before we learn how insurance works, let's understand who is involved. There are mainly two parties. The first is the insured and second is the insurer. The insured is the person or business protected by the insurance policy. For example, if you buy insurance for your car, you are the insured. The second party is the insurer. The insurer is the insurance company. The insurer collects premiums, provides coverage, and pays claims when covered losses occur. Think of it this way. The insured buys protection, insurer provides protection. These two terms will appear throughout every insurance policy, so it's important to understand them clearly. Just go through the definitions again, you will be all good. Now let's talk about risk. Risk simply means uncertainty about outcomes. In other words, we don't know exactly what will happen in the future. The risk can be positive or negative. A positive risk means there is a chance of gaining something. For example, suppose you buy a house today for 300k. A few years later, the value increases and you sell it for 400k. That is a positive outcome. A negative risk means there is a possibility of loss. For example, the same house could be damaged by a fire or storm. Insurance mainly focuses on the negative risks because they can cause financial loss. The goal of insurance is to reduce the financial uncertainty caused by those negative risks. Let's look at one of the most important concepts in insurance. It's called the risk transfer. Suppose Yuan buys a home worth 400k. He knows that a fire is unlikely, but it is possible, right? So instead of saving 400k in case of a fire happens, he purchases insurance. He pays a premium of 1200 per year. By paying that premium, Yuan transfers the financial consequences of a possible loss to the insurer. If a covered fire occurs, the insurer helps pay for rebuilding the home. This is called risk transfer. Rather than carrying the entire financial burden himself, Yuan transfers much of that burden to the insurance company. This is one of the main reasons people buy insurance. So, risk transfer explains who takes the risk. Now let's understand where the money comes from. This is where pooling comes in. So pooling means many people contribute small amounts of money through premiums. The insurer collects these premiums and places them into a shared fund. When losses occur, money from that fund is used to pay claims. Think about it like a community fund. So everyone contributes a little, only some people experience losses. Those people receive help from the shared pool. Without pooling, the insurance would be extremely expensive. And pooling helps spread risk across many peoples. Here, insurer manages the pool, insured contribute to the pool. So let's talk more about it with the example, auto insurance pool. So there are 1,000 drivers buy auto insurance. Each driver pays $800 per year. So the insurer collects 1k into 800. That is 800k total premium. This 800k becomes the insurance pool. Out of 1,000 drivers, 950 drivers have no accidents. Only 50 drivers have accidents. Average repair cost per accident is around $6,000. So total claims paid 50 into the $6,000, that equals to 300k. So now the insurer pays that 300k from the pooled 800k. The shared pool covered those losses. No single driver had to pay $6,000 alone. I hope this explanation will be clear. So see the picture that I have shared an example auto insurance pooling. Now let's talk about the benefits of insurance. Insurance provides several important benefits to individuals, families and businesses. So the benefit 1, pay for losses. The first benefit is that insurance helps pay for covered losses. This process is called indemnification. This term might be important. Please understand it carefully. Indemnification means restoring a person or organization to the financial positions they were in before the loss occurred. For example, suppose your phone is stolen and its current value is $800. If the loss is covered, insurance may pay approximately $800. Similarly, if your home is damaged by a covered fire, Insurance can help pay for repairs or rebuilding costs. This helps people recover financially after a loss. And let's move on to the next benefit, helps manage cash flow uncertainty. The second benefit is managing cash flow uncertainty. Instead of worrying about a huge unexpected expense, people pay a smaller and more predictable premium. Let's use the example. Suppose your home could cost 200k to rebuild after a total loss. Most people cannot suddenly come up with 200k, isn't it? Instead, they might pay around 1200 per year for insurance coverage. Paying a predictable premium is much easier than facing a massive unexpected expense. That's correct. Let's make financial planning easier and reduce stress. The third benefit is helping people comply with legal requirements. Certain types of insurance are required by law. For example, in many states, drivers must carry auto insurance before they can legally drive on public roads. Another example is a workers' compensation insurance, which many employers are required to provide for their employees. Insurance helps individuals and businesses meet these legal obligations. And the fourth benefit is promoting risk control. Insurance companies encourage people to take steps to prevent losses or reduce their severity. For example, installing a home security system may reduce the risk of theft. Smoke detectors can reduce the risk of severe fire damage. Because these actions lower risk, insurance companies may even offer lower premiums. So, insurance not only helps after a loss occurs but also encourages people to prevent losses in the first place. So far, we have seen that insurance pays for losses, helps manage financial uncertainty, meets legal requirements, and encourages safer behavior. Now that we have discussed the benefits of insurance, let's take a step back and look at the bigger picture. Why does insurance matter so much? Insurance protects people and business from large financial losses caused by unexpected events. Simple definition. Yeah. Think about a home. Home can face risks such as fire, storms, or flooding. Those events may not happen often, but when they do, the financial impact can be significant. Without insurance, people may have to pay for those losses entirely on their own. With insurance, they have financial support when they need it most. Instead of worrying about a large unexpected expense, people pay a smaller premium regularly. This makes expenses more predictable and helps families and businesses plan for the future. So, insurance is not just about paying claims, it's about providing financial security, stability, and peace of mind. So, to understand insurance even better, let's look at an important concept called loss exposure. We briefly mentioned loss exposure earlier, but let's look at it in more detail. A loss exposure is any condition, situation, or activity that creates the possibility of a financial loss. Notice something important: the loss does not actually have to happen. The possibility alone is enough. Let's look at a few examples. Suppose you own a house. There is a possibility that the house could catch fire. There is a possibility that a storm could damage the roof. There is also a possibility that someone visiting your property could slip and fall and get injured. Even if none of these things ever happen, the possibility exists. Because the possibility exists, The loss exposure exists. Insurance companies identify and evaluate these loss exposures before providing coverage. Understanding loss exposure helps us understand why insurance is needed in the first place. Now, let's see how insurance helps people in everyday situations. Let's look at some practical examples that show how insurance can help in real life. Suppose your phone is stolen. If the phone is worth $800 and the loss is covered, insurance may help pay for that loss. Now imagine you are involved in a car accident. The repair bill comes to $5,000. So instead of paying the entire amount yourself, insurance can help cover most of the repair costs. Let's take a bigger example here. Suppose your home suffers major damage from a covered event. Repairing or rebuilding a home can cost hundreds of thousands of dollars. So most people cannot afford that kind of expense unexpectedly. Here, insurance helps by covering a significant portion of these costs according to the policy. These examples show how insurance turns large unpredictable expenses into smaller manageable costs. That's one of the biggest advantage of having insurance. That's cool. Yeah, but insurance doesn't just help individuals, it also benefits society as a whole. Insurance plays an important role beyond helping individual policyholders. It also benefits businesses, communities, and society. Firstly, insurance encourages safer behavior. For example, installing a home security system may reduce the chance of theft, which we have discussed earlier. Smoke detectors may reduce the severity of the damage. Because these actions reduce risk, insurance companies may reward them with lower premiums. If you install all this, there may be a higher chance that you are paying lower premium. Secondly, the insurance helps people use their money more effectively. Instead of keeping large amounts of money set aside for emergencies, people can invest that money in education, business growth, or other goals. Thirdly, the insurance helps people obtain loans. For example, banks often require homeowners insurance before approving a mortgage. This protects both the homeowner and the lender. Finally, the insurance helps society by spreading losses among many people. When losses are shared, people are less likely to face financial hardship or bankruptcy after a major event. This contributes to a stronger and more stable economy. Before we finish, let's review the key concepts that we learned today. Let's quickly review the key terms from today's lesson. Insurance. It's a risk management technique that transfers the financial consequences of loss exposures to an insurer. Next, the insured is the person or business protected by the policy. Insurer is the company that provides the coverage. Risk, it means uncertainty about outcomes. Transfer means shifting the financial burden of a loss. Pooling, which means many people sharing the cost of losses through premiums. Loss exposure means any condition, situation, or activity that creates the possibility of a loss. If you remember these concepts, you'll have a strong foundation in insurance. In this lesson, we learned why insurance exists, how risk transfer works, how pooling works, why insurance is important for individuals and society. Yeah, that's all. Thank you for watching this introduction to insurance lesson. I hope you found this video helpful and easy to understand. If you enjoyed this lesson and would like to see more lectures on insurance and risk management topics, please like the video, subscribe to the channel, and share it with others who may find it useful. Feel free to leave your comments. I'll try to cover them in future videos. Thank you once again. I'll see you in the next lesson. Bye bye.